My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. Other people want to make friends. I'm just trying to help you not lose money. Because my job is not just to entertain you, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Some companies, they have to play by the rules. Others just don't. The trick is knowing which is which. That's what this market has devolved into, a two-track affair that's bounded by highly subjective judgments about earnings, and it's all colored by an epidemic in China that's going global. With the Dow backsliding 128 points today, S&P shedding 0.16%, and the Nasdaq dipping 0.14%. Why don't we start with the coronavirus, which is what drove the market down today? Regular viewers know that I've been a harsh critic of the way China does business. The People's Republic is an authoritarian dictatorship, and dictatorships don't need to answer to anyone, which means they can lie with impunity. So when the Communist Party puts out positive, albeit false, coronavirus numbers, big deal. Sure, somebody's head will roll if they get caught, and it looks like that's happening to some of the hapless party hacks who ran the government there at the heart of the outbreak. But the reliability of these numbers was always highly questionable. I've told you again and again, you need to take official statistics from authoritarian regimes with a grain of salt, or in this case, a pillar. Yet Wall Street, in all its infinite wisdom, has been trading off these numbers like they're gospel. Traders buy the S&P 500 when the infection numbers slow, then they sell when those numbers go back up. Last night, they went up big because the Chinese government started using a new diagnostic standard. Though the figures, they're probably still inaccurate. I say betting on official statistics for the People's Republic of China, I think that is a fool's game, and here's where you will land.
The House of Pain.
Yesterday, we thought the outbreak was under control because the data looked good. Today, we think it's out of control, not under control. Coming here quickly, that it can't be contained, that it's every man and woman for themselves. Look, I have no illusions. Like many others, I've tried to figure out which experts in medical journals are authoritative, which ones to trust. Now, some of the smartest minds out there are saying right now that it is too late to stop this virus. And it's going to be a worldwide pandemic. Millions will end up getting sick. Many will die. They make these dire predictions because the disease is more infectious than we thought initially, and the incubation period might actually be longer than 14 days. Some say it might be as long as 24 days. Plus, the virus keeps mutating, which makes it very difficult to come up with a cure. Of course, there's another camp that says the coronavirus will burn itself out come April when the weather heats up, that it will soon peak out, and your chances of catching it in America are minuscule. Where do I come down on this? If you're worried about your health, I wish I could help you. All I can say is wash your hands, keep them at your side, get masks and surgical gloves. Whatever you do, don't get on a cruise or travel to East Asia. That's what I've bought, the gloves and the mask, because I want to be ready for anything. Now, we have fire extinguishers and chain ladders and baseball bats in every bedroom to put out fire, escape one, or beat the crap out of the bad guys. Am I a little bit paranoid with the mask and the gloves? I don't know. Too soon to tell. The key here, though, is that everybody's assessment of this thing is subjective. That's the important word, subjective. The numbers are subjective. The articles are subjective. The forecasts are subjective. Even questions that should have an objective answer, like the disease's incubation period or the lethality, have become subjective because the Chinese have stonewalled or whitewashed, making it impossible to get a clear read of the situation. You know what else is subjective? Stocks in the time of corona. And when I say subjective, I mean a lot more subjective than usual. In this market, as unfair as it is to some managers and CEOs, many stocks are bound by valuation parameters, but there are a handful that aren't. Yes, most stocks are still traditionally valued. They're the market's plebeians. This morning, Goldman Sachs upgraded Caterpillar, for instance, arguing that machinery inventories are pretty low and production cuts will boost earnings down the road. To me, this was a very dicey upgrade because Cat has to play by the rules of traditional valuations. Maybe it can grow a little faster, but ultimately it's bound by its end markets. And most of its most important end market, it's China. Well, what's the demand from China right now? So I think you need to sell Caterpillar, sell, into the strength from Goldman's recommendation, which is exactly what we saw today. I simply don't believe it can make the numbers, and therefore the stock will falter no matter where it is, no matter when it occurs. On the other hand, this market has aristocrats that don't play by the same set of rules. Take Tesla. Here's a company that announced plans to sell $2 billion worth of stock, and almost immediately there are people using traditional metrics who are up in arms that Tesla dictator Elon Musk, yeah, he's a dictator too, told us he didn't need to raise capital when the company reported 2 weeks ago when the stock was much lower. Whoa, how outrageous. I said to myself, these people are delusional. Tesla's not like Caterpillar. Its valuation is a lot more subjective, which is how it could actually rally nearly 5% on this news, on the news, that it's selling more stock because Elon Musk needs more capital to meet demand. When you think of it like that, this is terrific news. So many people want Teslas that they need $2 billion to boost their production capacity. That is what I call a high-quality problem. Remember, for months I've been saying Tesla could raise $2 billion at the drop of a hat. Hey, I was right. The stock can keep rallying because, unlike Caterpillar, there's strong demand for the product around the world. You can apply the same lens to earnings. Cisco told us last quarter that demand in the enterprise, their bailiwick, is challenged. They said the same thing when they reported last night, and the stock got clipped. It's down more than 5% today. Hey, you know what? You know I like Cisco, but that makes sense. Cisco's a commoner, not an aristocrat. It's governed by objective metrics, and right now those metrics, well, they seemingly aren't that good. Contrast that with something like Shopify or Ring Central, which we'll hear from later tonight. Both of these companies are high-growth monsters, and that's all you need to know. I'm not kidding. The demand for their services is off the charts. So they report spectacular growth numbers, and their stocks keep flying. You don't even need to know where their stocks were trading. They go up no matter what. No matter how much they were already up ahead of time, they keep going up. They aren't even bound by gravity. This is highly unusual behavior, people, because in the old days, there were only two stocks that were like that, Amazon and Netflix. Those were the only ones. Now, though, because growth is at such a premium, thanks to the coronavirus-induced slowdown in China, many more of these momentum stocks are breaking free from the four walls of the spreadsheet canvas. There's tremendous demand for financial technology, too. Those stocks go up no matter what, day after day after day. There's little demand for just another bank, though, so those go nowhere. There's massive accelerating demand for all things cloud, so those go up and up and up. There's declining demand for oil and gas, so those stocks, untouchable. Sell. I'm going to say that to you many times, until every time we have strength, you do selling. Now, many investors hate what I just described. They hate it when stocks are valued subjectively, especially people who have been around forever. They like to be calculating ratios, examining discounted cash flows, tracing dividend trajectories, thinking about the E, thinking about the M, thinking about the P, price earnings multiple, pondering the correct earnings models. They don't want to look at price to sales multiples. They like price to earnings. They don't want to look at enterprise multiples. They like to look at companies as they are. They don't like unbridled momentum. These traditionalists, they fear buying high and selling higher. They think it's a money-losing strategy. To which I say, not right now, it isn't. The bottom line is that amazingly, and yes, counterintuitively, buy high and sell higher is working here. Buying high and not selling is the best. Oh, it's nutty. It's a virtuous circle with subjective assessments of the coronavirus fueling these subjective growth stock valuations. I bet it keeps going until the outbreak runs its course. I need to go to Steve in California. Steve.
Booyah, Jim. This is Steve from Costa Mesa, California. I'm calling about Eldorado Resorts. I've been following the casino stocks, and most of these stocks have been down due to the coronavirus. Eldorado Resorts has no exposure to Macau, and they have their pending merger with Caesars coming up. So, Jim, do you think Eldorado Resorts is a good bet?
No, I think it's too high. What's happening is that people are buying the domestic gambling stocks and don't want the international because the international have exposure to Macau, which is obviously next to China. The one that I like is Penn National, and the reason I like it is because of the hookup with Barstool. But that stock's gotten too hot, too. Let's go to Jonah in Georgia. Jonah.
Hey, Mr. Cramer. Thank you for taking my call.
Of course, Jonah. Great to have you on the show. What's up?
I have a question on Peloton. Can it recover from this drop it just had?
I actually think it can. Peloton is what's called a heavily shorted stock. There's a natural base of people who have to buy it on any good news. When we get good news, the stock will fly. I think this quarter is still a good quarter. I don't want to own it longer term because the stock's up a gigantic amount. But I think you're fine right now. Not great. I'm not crazy about it, but I'm not going to tell you you got to sell the stock. Okay, listen, we're in a subjective market, and I bet it keeps going subjectively until the coronavirus outbreak runs its course. Well, man, tonight, you've heard the phrase slow and steady wins the race. I'll tell you how it pertains to this earnings season. Then Mark Butler, the beloved CEO of Ollie's, passed away unexpectedly not that long ago. With uncertainty in the stock, what should your next move be? I'm giving my take. And if you like it, should you put a ring on it? With Ring Central up over 15% just in the past week alone, I'm asking the CEO if it's time to still consider the stock. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.